Okay, good afternoon, guys. Welcome to another live trading clinic. My name is Steve Ruffley. So, today, not all today, but today, right now, we're going to focus on the Bank of England. So probably, in all reality, the markets are waiting for the ECB rate decision later on this afternoon. So I've got some interesting kind of thoughts on these things, as always. So what we'll do is I'll just go through the risk warnings, etc. Then we'll have a bit of a chat about the fundamentals in England, the fundamentals in the European Union, look at the wider picture, go through some charts, and again, anything you want to see, guys, it's right into the chat window. Anything you want to go through, any product-wise in more detail, let me know. So just stack them up. So the quicker you put them in the chat window, the quicker we can come to them. We'll wait for the the Bank of England decision and the comments, and if we see anything good, we'll trade. So before I start, as always, you need to read the risk warning. It's spread betting, safety trading, carry high level risk or capital, resulting in losses that exceed your initial deposit. It won't be suitable for everyone, so please ensure you fully understand the risks involved. The information provided here in the known circumstances, consider offer or solicitation to invest. Nothing here can be choose investment advice. The information provided is believed to be accurate. The date it is produced. Again, education only. Content of the webinar is posted by the moderator at knowledgetrade.com. Content does not constitute financial investment or tax advice. Insurance comments does not accept any liability for the content and comments made during this session. Okay, so what we're going to cover, as always, live charting analysis. Multiple time frame trading. It's the only way I know how to trade. See what's happening on the higher time frames. Put it on a small and manageable time frame for your entry. It's as simple as that. Fundamental analysis, that's what today is all about. We're going to get new information. Any new information into the market will have a ripple through effect. Again, so we have to understand the product we're trading, the information we're getting, and what could potentially happen. Remember, I've got the 80-20 rule, though. The markets generally move 80% of the time, technically, 20% fundamentally. But even that 20% of fundamental news will move in a technical way. So all these things are interlinked. You can't purely be a technical trader without the fundamentals. And I would say these days you can't just be a fundamental trader, because you have to know where supply, demand, where support, resistance comes into the market in order to be able to get out of your trade, properly. So if we see anything good, we'll trade. We had some interesting moves in the markets yesterday, so I don't know if that's people positioning themselves for non-farm payrolls, but again, we have to understand where we are in the kind of current thinking. What are people thinking right now? Are people, waiting for a trigger from the Bank of England, seeing if that will have any effect on the ECB, or are people kind of positioning now for what's going to happen on the non-farm payrolls on Friday? Don't know. Interesting, isn't it? So we've got the main kind of markets up that we're going to focus on for this decision right now. So we've got the FTSE, okay, trading higher. We've got cable here. We've got the pound against the dollar, just kind of mid-range, really, kind of looking a little bit negative. And we've got gold. Always a good idea to keep an eye on gold when you're trading figures, just because it is so massively volatile. I mean, this was an interesting move yesterday. Obviously, I've got the kind of fib levels in here, these kind of like top red lines that I thought were good sells. So within about 3 minutes, I'd averaged in to about here. And then, well, you can see for yourselves, the market's hit, real key resistance for me. And there wasn't really anything up until 1279. So we had to hold on. Anything that kind of, moves that aggressively, again, you just use the Fibonacci. So on the hourlies, market spikes from here to here. It's going to get back to the 50%. Okay, when it closes below the 50%, it goes down. To be honest, I've taken such a big offside position. I got out at the 50%, and I made £1. So just goes to show you can't always win them all. But I didn't take a loss. But again, that's just Fibonacci in action. That's just a Fibonacci from this particular hourly spike from the high to the low. And the 50% the target. It's not just 50% nearly. It's not just 50%. It's 50% to the tick. Then once we close below that, the market then makes fresh lows. Okay, so Fibonacci is one of the most powerful tools you're going to use as a trader, and you can use it on any product and realistically any time frame above 15 minutes. Okay, so another thing to look out for. Again, that was a really good trading opportunity there. So what do we think is going to happen in cable today? It seems to run a bit of a bear run. Okay, so again, we've rejected the 50% of my kind of like fib lines up here. We haven't really looked back. So all the fibs have kind of acted as real resistance on the top end. So it broke through the low end, broke through this big weekly, monthly point here, not looked back. So big levels on the downside, 162188. Below that, we haven't got a great deal until we get down to 1.59. So if if we don't get the kind of right kind of answers today from Mark Carney, and what we're thinking today with Mark Carney, we don't think, I think 66 analyst poll have gone for unchanged rates, okay? So I don't think we're expecting any surprises today. But Mark Carney's backed himself into a corner. Now, the second that he said he's going to link a rates decision to the 7% unemployment rate, everybody in the market knew that was risky, okay? Because unemployment was high, it was always going to come down, the economy was always going to rebound in some way, you know, the stimulus has been pumped in overseas and in the UK. So I think he instantly regretted saying that. So realistically, what we're looking for Mark Carney to say today, it needs to be something to clarify this forward guidance. Okay, he's been very, very guilty of it, like Bernanke has from the Fed, and Mario Draghi, which don't go into because everything he says is just nonsense. But Mark Carney had high hopes for him, and I thought he was going to come out, you know, be a bit more bold, break the mold a little bit, and just be a bit more clear. You know, he's a very sensible guy, and he's got some good ideas, and he did, you know, he proved what he said worked in Canada. But what he hasn't done is give the market confidence and hasn't said, okay, well, we're nearly at the 7% unemployment rate, so what's my next step? You know, he hasn't give the market any clarity, hasn't give investors any kind of longer term or even shorter term hope of being able to figure out what he's going to do. I still believe that the UK will be the first to move on interest rates. Again, I'm reading articles all the time about the housing bubble in London. You know, again, we've got this surplus of free money. We've got all this money held in companies. You know, a certain generation of people holding on to money in the properties, and something's got to give. Okay, people are tired of inflation, tired of the pound in the pocket being able to buy less. And the only way you can control inflation is by interest rate. So for me, it's going to, you know, the UK are going to be first to move in interest rates. I've never been so certain of anything in my life, and just because other analysts out there don't think that or don't believe that, I don't care. To be honest, you know, I haven't made my money, I haven't made, you know, my reputation by following, you know, the pack, by being a sheep. I say what I want, and I back it up with my kind of fundamentals and technicals. So there we have it. You know, that's just my kind of wider view. I think Mark Carney today is going to have to say something. And it's when you're trading fundamental data like this, it's not fastest finger first. It's not waiting, you know, for the market to say unchanged, because that's not going to move the market. It's what comments come out. You know, what the rhetoric is, what the tone is. You know, all these kind of hawkish and dovish stances that I talk about, and that I say you have to be very kind of in tune with. These are little tiny nuances that people pick up on and make their trading decisions. I mean, it just looks bearish, doesn't it? It just looks like the market, you know, wants to hit lowers. So, you know, two lines, you know, weekly and daily close together, it just looks for me that the market wants to test lower. And if it starts, I mean, again, you look at the RSI, for instance. The RSI is telling us that we're getting towards the oversold territory. But remember, as you kind of reach down, you know, from this 37 level to 30, that's when the increase in bullishness happens. So again, you're going to get buyers when we're oversold, for sure. And, you know, again, look at the demarcation indicator. You know, we're looking for a bull reversal because, again, we're oversold. But that's where you get the most volatile moves, okay? See, when we're below it, you know, again, look at the RSI. You know, it's below 50 and it's hitting. That's where the most momentum is. Again, you know, the demarcation, we're hitting the 30 where we should get bull reversals. But then look how aggressive it is. And, you know, we see a good, you know, 100-tick move just based upon these two signals here. So I would always recommend when you're looking at your chart, you know, overlay some good quality oscillators. You know, it can be MACD, it can be, you know, the RSI. I quite like the DMARC indicator. I just think it, you know, it's nice. And again, it very, you know, ties in really well with the RSI kind of principle, the overbought and oversold territories. Okay, so we're looking pretty bearish now. You know, that just might be, you know, people taking a speculative bet prior to what Carney said. But I think, you know, the kind of technicals are telling us that we're bearish. Again, the Fibonacci's don't come back in play until, you know, the market starts to make some highs, because these are retracements. So until there, you know, we're well below the low level of the Fib. So that means that, you know, every high is a potential sell. That's gold, and that's you know, that's cable. You see the FTSE's got a big target of 655.50.5. Again, we're trading outside the Bollinger Bands. Again, RSI is creeping up. You know, we're at 64. 70 seem to be overbought, but it doesn't mean we can't go higher. I mean, what are your thoughts, guys? I mean, we've got some of the usual suspects in the room today. What do you guys think about what Carney's going to say today? You know, are you bearish cable. You know, you're going to buy some dips, you're going to buy some stocks. What do you think? I mean, we've got Chris in. Always good to see Chris. Have you got any thoughts on what's going to happen today? We've got Jamie. Good to see you. Who else have we got? Anybody else, guys? We've got Forex Gal. She always has something interesting to say. I mean, if you've got any thoughts at all, guys, you know, just type in the chat window. We're all in the same boat here. Has anybody got any preconceptions? Has anybody got any positions on now? You anticipating what could come out of the rates decision today? Okay, Lindy's saying buy on rumour, sell on fact. Must be bearish for cable. Yeah, I think that's a nice way of putting things. I mean, rumours are very, very powerful in the markets, and again with the kind of freedom of information and the ability to pass things around with Facebook, Twitter, you know, with very little regulation. Much more now. People are paying attention to rumours and paying attention to data via social media. I mean, back in the day, you know, when I was a trader on the kind of, you know, the big floors in London, you had to pay a lot of money for these data. You had to pay huge amounts of money to be you know, front of the queue to get good quality data. You know, thousands of pounds to subscribe to Reuters and Bloomberg every month. But now, people, you know, can freely distribute information, you know, in literally seconds, in almost real time. So it just means you get that extra reaction in the markets. So you get the first initial move, and then, as I say, and when I trade any kind of real, you know, important data, you get that first initial push, you know, up or down. Then the market will retrace. It will come back to the 50% and either then retrace the entire move or go on to make fresh highs or lows. I mean, that's just Fibonacci in action. Again, as I demonstrated with the gold spike yesterday, that 50% is always the key level. So if you see, you know, that market take that information, switch to your 5-minute candles or your 15-minute candles, then from the low to the high, do your fib, and then see where we're trading. Because time and time again, these things work. Okay, Chris just saying, I think nothing will be said until Bank of England inflation report next week, when they will, or after, yeah, okay, when they will have the forward guidance. Yeah, I mean, I think it doesn't really kind of, yeah, I totally get where you're coming from, Chris. I mean, again, we're still waiting for answers, aren't we? I mean, it doesn't really matter if you're an economist or you're just a guy on the street. I think everybody knows that inflation is high. You can tell inflation's high because, you know, have your train fares gone down? Have your electricity, gas bills gone down? Has petrol gone down? Has your food shopping bill gone down? The answer to all these things is no. Then that's real inflation. Okay, that's real inflation affecting how we live day to day. And I don't think anybody can say that bills are cheaper or, you know, the cost of living is cheaper. It's certainly not. And that's inflation in play. And that's what I think the pressures will come from in the UK, that we'll just get sick and tired of seeing our money eroded and not getting the pay rises. And while, you know, the banks have been recapitalised, UK companies have some of the biggest, you know, kind of holdings of money they've ever had. Our infrastructure's failing. You know, everything seems to be falling apart. So I think we need to get a grip on these things. And to be honest, the housing bubble is created by people holding too much wealth in houses. You know, it doesn't take a genius to know that, you know, when a certain percentage of the population reach a certain age, you know, they're going to die, and all that money that amassed in the properties is going to, you know, fall down the food chain to the kids. And, you know, property just is overpriced. It just is overpriced. And, you know, no more so than in London. Again, that's from foreign investors. It's, you know, it's just such a difficult, complex property market out there. But the one thing is, you know, it's, you know, you see it all the time. You know, again, it just, you know, I don't want to start going on to, you know, a Ruffley rant about these things, but we have to be realistic. You know, we all have to live in houses. We all have to, you know, have a certain aspiration for living equality, etc. But there gets a point where it's just too out of sync. Okay, when you're borrowing 5, 6, 7, 8 times your income to buy a house, just because it's gone up in value for the last 40 years of the property market, doesn't mean we can't have these corrections. Okay, you know, what goes up will come down. It's just cycles. You know, history has taught us this. So, you know, who knows, in the next kind of 20, 30 years, maybe we have this whole cycle where property prices just plummet and money goes, capital goes somewhere else. You just don't know. But anyway, what other comments have we got? So he's saying bearish on the euro after Draghi. I mean, I've been quite outspoken about the euro. I've been very kind of euro bearish for a long time. So anytime I see a spike in it, I'm going to be selling it. Again, I mean, everyone likes to say, all these other analysts and these market commentators saying that, yeah, the ECB, Eurozone's back on track, expecting good news. Draghi's going to keep interest rates at historic lows, maybe talk about negative deposit rates. All these things for me are bad news. They're not good news. They're just sticking plasters. Okay, the unemployment. Take Sweden, for instance. Their unemployment rates. Somebody where it's practically impossible not to have a job. Okay, because of the high taxes and kind of the good standard of living and the way they've built their society. And we've got upwards of 7% unemployed. I mean, it's worrying. It just worries me that there's a lost generation out there of people 18 to 25 who haven't had jobs for a significant amount of time and may never, get fully on that, on that working cycle. So I don't see the good news out of the Eurozone. So Mario Draghi saying today that he's going to keep interest rates low. What other choices he got? Is negative deposit rates a good idea? No, I don't think so. What other stimulus measures has he got? The Fed have pumped in, billions and billions of dollars to keep the US economy afloat. I just don't believe the ECB have that kind of power, have that kind of money. And I believe they were going to do, a quantitative easing type route. They would have done it by now. Okay, they've tried everything else the Fed has done, but it hasn't achieved anything really, has it? We're still at status quo. Okay, we're not seeing that growth driven by business, driven by the normal things we want. It's all driven by consumers. It's driven by cheap money and people releasing equity and spending. So the growth we're seeing out of every facet of the world, is all driven by the consumer, and that's not sustainable. So we need to get that growth, back from businesses. We see cable again. He's looking pretty bearish. I mean, I haven't heard anything over the wires, so maybe this again is just people getting short, before the announcement. Again, like I said, one spot 602 is a big, weekly nice resistance point. And again, when you see the market start to move between support and resistance, I find it very difficult to sell now because of the size of that candle. But realistically, it's going to test somewhere near, that level of 162 before some buyers come in. So this is the kind of technicals, trading with your fundamental view. This is how you trade. Okay, we all have access to the same information. So we have to kind of balance up, what could be said, what might be said, what the market sentiment is, with our technical trading view. Okay, London bears no relation to income. Right, yeah. London bears no relation to income. Okay, I'm kind of with you, I think, but no. I mean, I understand that, yes, the income in London is not necessarily, directly proportional to what people can afford for houses, etc., etc. But I mean, it's all you have to do is look at the gap between the wealthy and the poor. Okay, it's the largest it's ever been in history, and none more so than in London. Okay, so that is unsustainable. History's told us when the gap gets too big between the gap between the rich and the poor, something bad happens. Okay, that's not Steve Ruffley saying it. That's history, and history knows a lot more than I do. So I'm only, I'm only commenting on cycles and what happens. Again, we're seeing a bit of a bid going to the FTSE now. Wants to get to that 6,550 level. Cable still looking bearish. Gold not really doing anything. After that spike yesterday, I think we've got a lot of people nervous. A lot of people buying on the back of potentially seeing another big spike. It was never explained what that was. Maybe it's a fat finger. Maybe someone taking a long position. But when you see 158 tick straight move lines in something, you get nervous. Okay, these things are tough to trade. Greece will get another bailout. Yes, I mean, we have no choice. The ECB and Germany have proved that if bailouts are required, then we'll get bailouts. It's as simple as that, really, isn't it? Nobody's not going to bail out, and it's almost like too big to fail. I mean, Greece has got more debt now than it had, pre the crash. So I don't know. Has anyone been to Greece lately? Does Greece look like it's back on its feet? I don't know. Again, when you start to see these political movements and riots and very kind of untoward things happening, it doesn't bode well. So for me personally, the Eurozone, I just think it's still got a long time to go before it repairs itself. And obviously it's not as bad as it was, but it's certainly not great. I mean, the situation is certainly, I see a lot more challenges facing the European Union, its citizens, and Mario Draghi. And I just don't believe Draghi's the man for the job. I just don't. I don't have any faith in Mario Draghi. I think he's been a massive letdown. And I mean, I don't know. It's just my personal opinion. I'm just very weary of listening to these guys who are meant to have all the answers. And you have to remember, these people are just men. They're just guys, they're just normal people. They have high-powered jobs, and they're very, very clever, and they understand economics. But to be honest, economics is not that difficult. It's really not. It's what makes it difficult is people. That's what makes the world a difficult place, is interacting with people and keeping everyone happy. But again, something else history has taught us: we can't keep everyone happy all the time. Human beings aren't designed that way. We always want more. We always want the best for ourselves. And until we go back to a different way of thinking and making sure everyone has a kind of crack of the whip and has their allotted share, then the world will continue to function the way it is. It's just the way it is. Okay, so a few more things. Is not the ECB the only central bank where the balance is declining? Yeah, I'm not exactly sure on that particular fact, but that's a good point. Don't get me wrong. The ECB has done some good things, and the European Union is the second biggest kind of market in its own right. But when I'm looking for value and I'm looking for places to kind of invest and to kind of get involved, I still see a lot of strength in the UK, and you can't go past the US. The US has just done everything at every step to make sure that it's continuing on this strong, rebound. And everything looks fragile, doesn't it? Everything looks fragile. But, again, as a trader, you're playing the balanced odds and going for the percentage trade. And that, for me, is selling highs in the euro, is buying lows in the pound, and, it's buying some dips in the UK, in the FTSE 100, the FTSE 250. That's what I'm all about, but that's just my view. And again, I'm not always right, that's for sure. Okay, with the Bank of England rate decision move GBP, since no statement is expected. Yeah, of course. Again, it's not about the statement, it's about unchanged. There will always be, market rumours, market comments, something coming out after the event. So, excuse me, as we said, everybody's expecting unchanged, but it doesn't mean there won't be a movement in the markets after that, because there's always, again, people making fresh decisions, fresh trade based upon, that being an absolute figure. So if somebody says, yes, definitely no change, the market will still take a view, and maybe we'll get some dip buying in the pound. Maybe we'll continue to see these lower levels here. We just don't know, and that's the whole point of waiting for the data. Okay, Chris is saying Draghi broke the constitution by blocking the freedom of money transaction in Cyprus, and that should never, ever not be ever missed. It's one of these things. It's very easy, isn't it, for us to kind of sit here and say, well, I wouldn't have done this, I'd have done that. But, with great power comes great responsibility, and it's these things are difficult. Tough decisions have to be made, and there's going to be winners and losers in all these things. I think Cyprus definitely got a rough deal, but these things happen. It's survival of the fittest. You have to think of the size of Cyprus compared to Germany, compared to France, to Spain. There's bigger players, with more to lose. When you look at the GDP of Cyprus, it was less than 0.5% of the European Union. It was like literally insignificant. So tough for the people of Cyprus, tough for people who had money in Cyprus, but these things happen. They happen all the time, and there are winners and losers in this, these huge global markets. And sometimes, the finger of fate just points at you. Yes, morning, Ian. Absolutely, Zahid. The small will get bullied. When we're talking about central banks and the flow of money, it's a huge numbers game. Think about the Forex market. $4 trillion is traded every day. Who do you think that is? It's not Steve Ruffley in his account. It's huge investment funds. It's central banks. This huge flow of money constantly circulating around the globe. So, if you're Cyprus, you just don't have the power that France have, that Germany have, that other big nations have. It's just the way it goes, I'm afraid. Life's not fair. Trading's not fair. It's that is just a fact of life, isn't it? All right, guys, we've got about 5 minutes before we're going to get this call. So I think 66 analysts on Bloomberg polled the majority, all of them say there'll be no change. But again, we're going to listen to any rhetoric, any kind of clues, any kind of hint. Market driving is under pressure. It's under pressure because we're getting close to that 7% unemployment rate. And the UK economy seeming to be a little bit stronger, and we're seeing upticks in the FTSE. There's a general mood that maybe this time we're out of the woods. Again, as I said, the housing bubble still worries me. The amount of personal debt still worries me. So we're not out of the woods yet. But we're going to have to wait to see what he's said, and if anything kind of really, he's going to move the UK market. So maybe cable, maybe gold. Any kind of final thoughts or questions, guys? Anything you'd like to add? You'd like to ask? Any products you'd like to go through? We've got 5 minutes. Chris is saying he's not head and shoulders on the H1 pound. No, not really. It's almost like an inverted head and shoulders more than anything, because the head would have to be up here realistically. I think what it is, to be honest, we're kind of getting in a pennant style. Let's look at the dailies. Let's understand. We've got this nice, kind of trend that we've broken through here. That's why we're going down. It's just technical trading, and it's supply and demand. We've got. No, it's rubbish. We've just got a nice level of support on the dailies. We've basically, again, indecision on the days here. Markets then broke down. So again, do your Fibonacci's. Then we've started here. We've been to lows here. So we've not got anywhere near the 50%. And the 50% coincides back towards this trend line. Okay, so, again, these things all happen for a reason. So for me, the more we close below the 23.6 on dailies, we want to test the low, then the market's got this big gap to lead into. Okay, anything else? View on the DAX? Absolutely. Say, realistically, am I bullish or bearish the DAX? Right now, because this formation, look at the bollards. We've tried to get a breakout in the dailies, and it hasn't. We've rebounded. I reckon we get back to 9426. Okay, so I'm bullish, fairly short term. Talking days and weeks for the DAX. I can see the DAX gaining. Let's see, DAX gaining easily. 200, 300, 400 ticks, I would say, in the next week. But again, depending on non-farm payroll. So it's all about the data on Friday. Okay, so my view is good points to buy, and I think 9426 is a sensible place to get some money out. Okay, any thoughts on the euro, Japanese yen? Yeah, Alan's saying everyone and their dog thinks the cable's going up today. Well, again, I've just shown you from a technical perspective, they're actually, quite bearish. So, there's a lot of people thinking that it should go up and buying it. A lot of people are getting squeezed out of long positions. So a short squeeze we could see before it actually kind of comes back. Okay, we've only got a minute now, so we'll try and go through the Aussie dollar and the euro yen. Okay, so it's got the BoE coming up in just over 30 seconds or so now. So we're looking for a call unchanged. I'm going to listen to the rhetoric and give you my interpretation of anything new hits the markets. Okay, I'm going to go quiet for a few seconds. listen to these and reinterpret them, guys? So, yeah, unanimous, keeping rates at 0.5%. Yeah, going to keep it the same rate of asset purchase. So, again, fairly good news. So, realistically, again, it's like the situation in the US, that unanimous keeping interest rates low. Nothing really on forward guidance really kind of being released around that, and that was to be expected. But I think for me, the asset purchase being kept, that we're not actually kind of tapering like the US, will be good news for the market. So I'd maybe see the FTSE test 162.8.64 and maybe continue to gain a bit of strength, because again, that guarantee from the Bank of England we're going to continue on the asset purchase, it's got to be bullish. It's got to be. But then we'll have to see when we're towards the highs. 98 points up in Germany, 39 points up in the UK, hovering around 82 in the US. So nothing really kind of as we expected, guys. Like I said, unfortunately, it can't always be, the great moneymaker, the great exciting event that maybe the other data can be. I much prefer doing the evening meetings and doing the Fed, to be honest. The Bank of England are generally always a little bit dreary, but we are waiting for the ECB, and that is the main kind of showstopper today. So Bank of England, pretty much it seems status quo. We're continuing on the path we've chosen, low interest rates, and continuing the asset buyback. Carney's going to be pressed over the next kind of few days and weeks. He's going to be pressed to make this forward guidance clear. It's as simple as that, and that's when the cracks are going to show. I still maintain that we're going to be first to move on interest rates, and I'm not going to change that view anytime soon. It's all about inflation. It's all about people's standard of living. So I've seen a little tiny bid come into gold. I just do not trust gold at the minute after what happened yesterday. So don't be surprised now trading outside the Bollinger Band. We don't see that 1268 level to be tested again. Cable's done absolutely nothing. Okay, so for that initial sell-off, the market has bought back. But again, as Alan was saying, Alan was saying that everyone's expecting cable to go up, so maybe that's the final kind of push out here. Look at these hourly wicks where the market doesn't. So if we close above 1630.90, then the technical buyers will come back in, and that kind of looks right in the RSI. If we start holding, on the D marker, we'll go back towards, a bear reversal, so strength going back into the market. The RSI will probably, reject the oversold 30 level, so we could see technically trying to get back to the moving average. I would say get long, you stop below 162.602 and a potential target of 164420. So that would be the trading cable. So again, I'm bullish. That keeping interest rates on hold and the asset buyback is bullish. So we should see a little bit of a rebound of the pound against the dollar. You see, people buying the pound, versus the dollar. We should see the FTSE at least test these upper limits and this fresh high. Then you obviously expect gold to come down, but we're going to keep out of gold for now. What else have we got? So let's go through the Aussie dollar. The Aussie dollar is something that people ask me about all the time. So let's just do a quick view on that. So Aussie dollar, again, we spoke about these things, when was the low, and people said it couldn't potentially go any lower, and then it does. We've seen a bit of a rebound. I think when people were kind of talking to me, on previous sessions, I think we were more kind of back to these levels. It was like, could the market potentially go any lower from here, from 0.9, 0.557. I was like, well, you just don't know, and from there it actually did. Realistically, on the dailies, what is a good? Again, I'll show you a Fibonacci because I know I can just tell by looking at it that it works. From where the selling started on the dailies, okay, we're already above the 50%. Okay, so it looks like, from the way I interpret Fibonacci, that the Aussie will have to make a new high against the dollar. So we're looking at 0.90858 or 90557 as being the target. So it's not, an amazing trade, with 77, 100 ticks up. But, just look how the market has reacted. Okay, the market has gone from here to here, from the highs to the lows. We've seen the market try to get back to that 50%. Okay, it hasn't. Look at it this way. Okay, the market, we know that the market's gone from the high to the low. Okay, so the market's gone from the high to the low, but in the meantime, it's got to the 50%. Yeah, couldn't close above it and make a high, so the market then has rejected and made fresh lows. That's the low of the market. Indecision closed inside the daily Bollinger Band. We've then headed towards key fib level, so 23.6, 38.2. Haven't managed to get to the 50. Market then sells off. Can't make a new low. Buyers come back in, goes straight through the 50. Yeah, straight through the 61.8, but can't get to the 100. So comes back to the 50 to test. More buyers come in to push it up. Therefore, okay, on the daily charts, we're going to see a new high. Yeah? In the next week, the next 5 days of trading, the Aussie dollar makes a new high. It can't do anything else. Depending on the fundamental news on Friday, of course, taking that out of the equation. But from a technical perspective, now we've closed and rejected a close below the 50% of the daily. That has to make a new high. So look at the same kind of scenario on the hourlies. Again, we see the market, bang, that's the 50%. Support, market comes down, support resistance, yeah, wants to go higher, rejects a close, higher, come back down, so we've got to do a mini fib on this. So again, mini fib, 50, closed above it. In this scenario, we have to make a high. On the bigger scenario, we have to make a high. So the market has to make a high. It's as simple as that. It might come down a little bit towards the moving average, but you've got 100 ticks upside on the Aussie dollar. It's as simple as that. It has to go higher. Okay? You heard it here first. Anything else? Is that answered your questions, Carl? Is that what you want to know about the Aussie dollar? Does that make sense to you? It's Hid saying good retail numbers last night from the Oz. Yeah, well, good retail numbers means it's bullish. It's going to send the Aussie, up against the dollar. Simple as that. Anything else, guys? Anything else we'd like to ask? Anything else would be interesting? Anybody got any thoughts on the ECB later on? Has anybody taking any positions into the ECB? Has anybody got any thoughts about what potentially Mario Draghi could say? Again, I think there's a little bit of, it's not quite as clear cut as the Bank of England. There has been kind of talk about the ECB actually cutting rates. I don't see it personally, but you never know. You never know with Mario Draghi. You never know with the ECB. Will a cut in interest rates actually do anything? Well, interest rates haven't stimulated the right kind of growth yet. So I personally don't see how we could justify another cut and expecting anything different to happen. It's like Einstein's theory of madness, doing the same thing over and over again, expecting a different result. Just keeping interest rates low has not stimulated business growth as we want it. It just hasn't. So why should we lower interest rates? How do you find out where you will take profit using fibs by the retracement? Okay, Milan, good question. Well, what you need to do is look for, key points. Key points. The 50%. If we found support and you're looking to go long, well, you take some profit out at the 61.8. But if you're looking longer term, you don't take your profit out till 100. Okay, but any significant, support or resistance levels in the meantime, will, be where you could get out. If you're long, from these levels here, then the 50% is always the target. But realistically, you're just looking for any key point of support and resistance. And, I'll show you. I'll show you the only way I know how. Okay? So I'll pick something at random. Okay, I'll just pick a random product. Scroll down. Random. That. So that's the US dollar against the Polish currency, Lottie, whatever it's called. So here is an hourly chart. Okay, so hourlies, where do you start to kind of build your picture? Well, look at the dailies first. That's what I do. So market, lower high, now rebounded. So something's made the market go down, reject here, and then want to go higher. So we fundamentally change from selling, to buying. And we could see that here. Okay, so the market again has pushed through these triple tops, indecision and the market's now coming down. So realistically, where do we find some sort of, some sort of clarity? Right. Well, I find some clarity. That's a weird chart. I've just shot myself in the foot here. Well, first of all, let's just take a bigger picture view. Okay, so bigger picture view is the market is again been aggressively selling off. So it's sold off from the highs, back in August 2013 to the lows here in December 2013. So simple. No real coincidence that the line I just drew in that I thought was a good point of interest is a couple of ticks away from the 50%. Okay, so that's the 50%. So we can move that line to the 50%. So we're trading below that. So the market, again, as we say, if the market wanted to go back higher and make a new high, it would have to have closed on the dailies above the 50%. So we've rejected that. Okay, so let's just take that fib or Fibonacci off. So that's given us a point of reference. Okay, so the 50% now in this is a point of reference. We then go into the hourlies. We try and see whether that 50% plays into the smaller time frame view. Okay, well, again, if you want to do the retracements, then the market really starts to get bullish here. This really nice level up here, it's double topped and comes down. So we know we're trading below the 50%. We saw that on the dailies. So what else is another good point? Well, the 50%, okay, I don't think anybody can argue that that's a nice key point of interest in the market. Acting as really good support on the hourly, now broken through. So it looks like we're getting weaker. So the dollar's going to weaken, and it looks like we're going to get to the low point, to the 100%. So if you're looking to get short, then your target, again, will be a close below the 61.8. You would have your 100% and your 161.8 overextension. So just quickly take off Fibonacci. So there we go. I mean, if you're just looking now, if you're just purely trading off, let's put some other indicators in just quickly, just to indicate what I'm saying. Okay. So, you're starting to get a bigger picture now. Consolidation, tight, rejection of the upper Bollinger Band. So he's looking to go lower. Okay, so we continually close below 3.09550. The market will look to test this double bottom in the Bollinger Bands. Again, the RSI is kind of looking weaker. Okay, we've come back to try and test the 50%. So remember that 30 is where we're going to get the reversal and thereafter. So it looks like that's coming down. It hasn't made a higher high in the RSI. So down, down, down. So if you want to make a good short call on the dollar versus the zloty, then it's a close below 3.09950. Your target is around 3.05705 for a fib. Now, that's a long way to drop. Okay, that's a long way to drop. So what you need to do is find a point of interest. Double bottom, that's a point of interest. Here, point of interest. So if you want to go short, initial targets are 60 ticks, 129 ticks, 380 ticks on the low side. Now, don't get me wrong, the market can push up around here, but the more we close below this 50% on the hourlies, the more, according to laws of Fibonacci, we're going to make new lows. So take a screen print of that, guys, and just look at it over the next day, the next week, and see if it comes true. Take a screen print, note down these levels, because what I'm saying is that the market, for me, looks bearish. It's going to come down. Lower high, lower lows. Market's going to consolidate, going to break down, and these are your targets. So these will act as support resistance, these like support and resistance, and this is your overall target. Not to say the market won't spike and get to here, push all the shorts out, but I would say over the weeks, my Fibonacci view, my personal view, depends again on non-farm payroll, is that we get to these lows down here. Okay, so that's just how you would interpret Fibonacci on a daily, Fibonacci on an hourly. Put it all together with your support and resistance, and then tie it in with your oscillators and your Bollinger Bands. Simple as that. All right, guys. Well, listen. You all get ready for the ECB. Be lucky, stay safe. Don't take too much risks. Thanks to Maud, Vicky, Adina, the guys at FX Street. It's been a pleasure. Anything else you want to know, guys? Follow me on Twitter @Steve Ruffley. All right, guys. Take it easy. Have a great afternoon, and I'll see you all soon.